Okay, let me start. Welcome to the webinar on capital market development, China and Asia. Today we have a fabulous speaker and a fabulous discussant. The speaker is Professor Lin William Tong from Cornell University. And the topic is the rise of e-wallets and buy now, pay later payment competition, credit expansion, and consumer behavior. And our discussant is Deniz from Washington University at St. Louis. Now, the presenter has 25 minutes and the discussant has 25 minutes. Then we have a Q&A session of about 20 minutes. Before I let Will talk, I also have two announcements to make. Number one is, for this very nice webinar series, we decided to collect opinions and recommendations from everybody. So there will be a call for papers out on ABFER website and will be sent out to everybody very soon. And that's the first thing. And the second thing is, we have the December 14th speaker being Professor Bohui Zhang. You probably already know him. So we will send out the new flyer for the next talk pretty soon. All right. I'm done with everything I need to say. Well, you can start 25 minutes.
Well, thank you very much, Diane, for the introduction, and to the organizers for having us, and my co-authors, Ji Yang and Wenlong are also here with us. Let me just share my screen here. As I do that, a very good morning, good afternoon, good evening to all the attendees for the webinar series. And what I hope to share with you today is our recent work related to digital wallets. Many of you know that my co-authors and I have been working on, Web3, blockchains, AI, big data, so on and so forth. But if we take a step back and think about the landscape of digital economics and fintech, Web2 based, internet based digital payments, digitization actually constitute the largest part. And that's what's driving economies around the world over the past decades. And yet we have limited information on what's going on within that space in terms of transaction level data, account-based characteristics, so on and so forth. So that's what we're going to look into. We're mainly going to consider three aspects. One is competition among various payment options within digital wallets. So we're going to open the black box of digital wallets for the first time. And to think about how they compete. Are they complementary? Are they substitutes? Then we're going to look at how buy now, pay later as a new form of household credit expands credit on both the intensive and extensive margins. How is that related to financial inclusion, if at all? And lastly, we're going to look at how that affects consumer behavior in terms of their consumption, in terms of their borrowing behavior. Okay, so I don't have to especially to this audience, I don't have to motivate too much why we are looking to this. Right? There is this phenomenal rise of digital finance, digital wallets. It's supposed to, or at least people believe, is revolutionizing the way we conduct our daily activities. And it is true. I'm actually in Beijing right now, and after several years not being able to come back due to the pandemic, I really feel it. I'm using WeChat Pay, Alipay every day. I don't carry a wallet, and I think the pandemic definitely accelerated the adoption of e-wallets and super apps. I'm going to touch upon super app in a little bit, but safe to say there's a global rise in digital wallets, which is synonymous with e-wallets, which less mobile wallets. It doesn't have to be mobile. It can cover both online transactions and on-site transactions. Now, within e-wallets, there are many options. One particular innovation that happened over the past years is the buy now, pay later option for the users to make their payments, to take short-term liquidity and credit. Now, both e-wallet providers such as Alipay, PayPal, as well as fintech startups have introduced buy now, pay later. And there are two major business models for buy now, pay later. One is the merchant partner model, where I try to embed my BNPL functionality into other platforms, other businesses. That's the model that's followed in Europe, in the US initially. And for a good reason. The interest rate was generally low, and the funding for consumer credit was quite easy to do. That's no longer the case. So you actually see a global convergence to what is called a app-driven model, especially super apps, where you actually build a ecosystem. And whether that payment function, that buy now, pay later function is making a big profit or even positive profit is not crucial. The idea is to get people on board to utilize the whole ecosystem, both as a way to incentivize proper behavior and as a way to make the business more sustainable. What's interesting is that due to regulation, fintech regulations in China, where we have the biggest super app models, these businesses are transitioning into more smaller pieces or more fragmented marketplace. So the ecosystem is actually being split up for antitrust reasons. And we're going to talk about that in a little bit. Safe to say that this is a huge market. It's continuing growing, and even in the US, the annual growth rate is over 200% since 2019. Okay, so with BNPL and some unique functions of e-wallets, we can create a way of making payments and getting credits that's independent of banks. Whereas traditionally, if we just use a pass-through e-wallets, that's just a bridge to banks, but there isn't as much innovation in terms of payment. So a few questions naturally arise in this setting. How do these various payment options compete? Do BNPL crowd out credit cards? Right, credit cards would be a alternative form of credits for household, at least. And how is that related to cash? I really don't carry cash with me anymore in China. And that's happening in many other places as well. I didn't get to mention that both e-wallets and buy now, pay later, quickly, took off the ground in other countries as well, including the Philippines, Thailand, Vietnam, and later Singapore and Australia embraced that, as well. And now in Europe, in the US, are active. Right? But to the extent that it extends credit access to households, is that to the underserved consumers, or are they just competing with bank credit? That'll be interesting to find out. And earlier literature, which our discussant Deniz has contributed to significantly, is that when we increase household credit, consumers actually spend more, but sometimes they become more indebted. There's more frequent delinquencies. Whereas in our setting, we actually find something different, and there's actually a good reason why it's different. We'll come to that in a little bit. So let me just provide an overview of what we do here. Right? We look at a very unique data set. It's arguably the largest e-wallet provider in China and in the world, with a user base that's pretty much representative of the Chinese population, aged between 16 and 60. And we get I'll talk more about the details of the data, but we'll basically get transaction level data. We can match that with merchant and consumer characteristics. We also have a randomized experiment that helps us to get certain identification, causal identification, in terms of how BNPL affects consumers' behavior. Our key findings are threefold. So the first one is we do find BNPL and internal payment options. That's not true. Banks, always in digital wallets, dominate the transaction space. In particular, BNPL constitutes more than half of all transactions. And it does have a credit expansion function. Many consumers are getting access to credits for the first time, and many merchants are also accepting BNPL. The adoption rate is way higher than credit cards. And we can see there's a effective financial inclusion in terms of how it is helping regions, less developed regions, female consumers, younger consumers who are probably more financially constrained. And in terms of consumer behavior, what we observe is that there is indeed an increase in consumer spending, but not in indebtedness or defaults or delinquency. Actually, the default rate is less than 1% in our sample, and overall it is well below 2%, according to the e-wallet providers' information. We don't get to see the exact details there. Now, in the interest of time, I'm going to kind of skip the literature, except that I want to highlight here we're studying household credit, not merchant credit. There is a prior literature talking about how fintech or tech-fin credit that goes to online merchants. Now, there are several studies using either European or US data looking at BNPL. They are mostly inferred BNPL transactions from bank transaction data. Ours is the first e-wallet data matched at the transaction level with merchant and consumer characteristics. And this is also the first time that we have a randomized experiment on BNPL. I think that literature is growing. I advise the New York State Office of Financial Services. BNPL digital wallets are very much in the discussion. What we also do new, that's adding to earlier work by, for example, Deniz and several other authors, is that we offer an ecosystem perspective to explain, to rationalize why people are increasing consumption without incurring a greater, debt or delinquencies. So, in the paper, we provide a long section on the institutional background of e-wallets and BNPL. So I'm not going to touch upon that too much. I just want to mention this super app idea. It's basically building a digital ecosystem, where, your behavior in terms of borrowing and all that will affect your access to other services and functionality. You start to build a credit within the ecosystem, and that explains your that's quite unique. That's what many digital wallets are converging to. Now, very quickly on the data side, we basically look at June 2020. In the paper, I explain why June is not affected by national holidays. It's representative for the consumption behavior throughout several years. We randomly take 550,000 transactions online and another 550,000 transactions for on-site that are representative of the population. I have mentioned that the user base is essentially the population in China. And the second data set will be from this randomized experiment conducted in June and July 2017. Basically, a treated group were offered BNPL, notified of their credit limits right away. Control group didn't get that for 2 months. They didn't anticipate getting that in any case. And then 2 months later, they got it. We worked pretty hard to extend our data set over the past several months to observe more behavior of this group of both treated and control all the way through December 2021. So you can look at both short-term and long-term behavior. And also this is the first time that we get to see the ecosystem information, such as how the users are building their credit scores within the ecosystem, how they use that to access other services such as free rental or even green finance. in terms of apps that allow you to plant trees. And unfortunately, due to data security law and personal information protection law that was introduced, I think in June to August 2021, we're not allowed to take out more detailed information in many aspects. But here I'm just showing you the ratio that reflects the pre-trend. This is the ratio of monthly consumption of treated to control users before the experiment and after the experiment. The treated increased their consumption, but before that, there's essentially a parallel trend. So 3 sections of the paper that we look at, right? The first one is just competition among payments and what payment options do digital wallets offer. Typically, they offer link credit card, debit card. There's e-wallet balance, the e-wallet saving account, which offers some wealth management products, and e-wallet credit, predominantly BNPL. And we do see internal payment options for both on-site and online transactions dominate the space. BNPL also dominate other transactions. And here I just want to quickly mention, because of this dominance and because the internal payment options bypass the bank side, that could be the motivation for the call for more open data, not only open banking, but open data initiatives. And also a reason for why we want to introduce eCNY, just to get access and control of payment information, payment data, because they are no longer available through banks. That's just a remark on the side. BNPL offers both quick liquidity credit and is accepted by online and on-site merchants, which is not the case for credit cards, at least not in China. And it actually allows you to build credit. So compared to other payment functions, it actually offers the most comprehensive kind of desirable features. That's kind of why they become popular. Now here, I'm just running I think we did a logic model, and to look at how users with BNPL access, how does that interact with other payment options. Now here is descriptive and correlation, right? We're not trying to claim any causal effect, but people using basically 1% increase in BNPL usage would reduce the credit card usage by 15%, something like that. I think it's 14.33 or something. Yeah. So BNPL usage is definitely negatively correlated with all other payment functions. But what we find interesting is that 1% increase in 1% decrease in transaction value would lead to about 3.3% of BNPL usage. So what's happening is that BNPL is not directly competing with, say, credit cards. BNPL is covering smaller transactions, it's covering transactions on non-durables. So it's really playing the role of cash, new form of cash in this digital era. And we have more evidence in the paper that we present. And if you look at users with dual access to both BNPL and credit cards, you also observe that they use BNPL to clear smaller transactions, non-durables, but they pay for big tickets using credit cards. So in a sense, they are not in direct competition. There are multiple reasons why that's the case, right? Online merchants acceptance, the flexibility to bundle small transactions into one bill and then use BNPL to pay it off, either in several installments or, some BNPL design is essentially a virtual credit card. So they get that flexibility to pool their small transactions and to pay off with a buffer period where no interest would be accrued. And here what we are looking at is just the online and on-site separate tables. The effect would be quite significant for both type of transactions. And it kind of makes sense if I'm a mom and pop store for, let's say, breakfast, I wouldn't want to accept credit card. It's kind of troublesome and I pay a high fee. Whereas because most people are using BNPL or using digital wallets in any case, many such smaller merchants would accept BNPL. And it's a two-sided market. The increasing adoption on both sides eventually lead to overall increase in transaction, BNPL transaction. And we report more details of this in the paper. Now, I know I only have a couple of minutes left. Let me just report to you the second part and third part of the paper. The second part look at credit expansion. And let me show you what we have here.
You have 6 minutes.
Oh, okay. So that's a bit longer. That's great. So it shouldn't be too surprising that BNPL expand credit access on the consumer side, right? Because it's not as stringent as bank credit card access. Potentially because there's more data available, so you don't have to go with the traditional metrics. But in general, digital wallets are more lax, but they're clever. They find ways to ensure the users also behave properly. We'll come to that in a bit. And this is the first time that we directly observe whether BNPL users have access and linked bank credit card as well. Whereas in earlier studies, we just have to infer that from bank transactions. But what's more interesting is that there's credit expansion on the merchant side. That's something little discussed in the literature. Again, we directly observe merchants' acceptance of credit card and BNPL. So we can see that overall, in terms of transactions, over 90% of on-site transactions, 60% of online transactions cannot be completed with the card. It's the reason that you can argue in China for a long time as a developing country has not built a very complete credit reference system, so on and so forth. Whereas it has accumulated a huge amount of data and because they are all digital, you can develop digital credit reference system that's helpful in providing more credit access. BNPL, on the other hand, 47% on-site transactions and 82% of online transactions can be completed with BNPL. So it's playing a pretty big role. And in the paper, we look at how it's really expanding the extensive margin, right? New users, new merchants signing on. Here are just some examples of merchants accepting that. And we also look at the heterogeneity of credit access. We find that regions, less developed regions, northern and western regions, my hometown is in northeast China, unfortunately, is in that less developed regions. They actually benefit more from digital wallets, from BNPL, and also female consumers as well as younger users, right? So that's interesting to us. The third part of the paper finally looks at consumer behavior. And if I am to summarize the effect of introduction of BNPL on consumption, and here we're claiming a causal effect because we have a randomized experiment, is that the control group that's given BNPL access increased their consumption by about 80 to 90 RMB, which is over 5% of their average monthly consumption. So that's quite significant. But we don't see a lot of we don't see defaults. We don't even see a lot of interest accrual. So I'm going to come to that on the next slide. But in terms of the increase in consumption, what theory, which hypothesis would explain the result? We looked carefully into the again heterogeneous results in the increase in consumption following the earlier work of Deniz actually to figure out what would be more consistent with the empirical observation. And we find that buffer stock hypothesis that Carroll 1997 introduced and what Deniz has tested in his AER paper as well would explain that best. It's definitely not a permanent income hypothesis. the response, right? $1 access, 1 RMB access to credit doesn't increase consumption 1-for-1. Here you see it's less than half for sure.
Excuse me, Will. A quick question,
Yes.
a quick clarification.
Yes.
Your consumption is based on what? What's your consumption data here? I missed that
consumption
point. Sorry.
Yeah, it's all consumptions within the digital wallets. So we don't see payments.
So it's total. Total digital spending.
Yes, based on the
Thank you.
Yeah, it's great to clarify that. And the digital wallets pretty much covers the entire population, right? In terms of distribution of credit card ownership characteristics, they match the population pretty well. So in that sense, we kind of want to draw that conclusion, right? This is a quite general phenomenon. Now, if you look at these curves, these are consumption response plotted against age. So we actually didn't quite find a monotone effect as Deniz saw in his paper, partially because the actually younger people are more constrained, so they benefit more from the relaxation of their constraint. But the more aged population, they probably miss the fastest growing period of time after China joined WTO, so on and so forth. So they probably didn't accumulate as much wealth. So they are also financially constrained. That's how we are reading this graph. The histograms are just the share of each group, right, within the user base. And on the right hand side, we have the number of credit cards on the horizontal axis, and then the consumption response. So that's all consistent, right? You have more credit cards, it's typically less financially constrained, you consume more. But what's interesting is that, you know, there is not a lot of people who become revolvers, constantly borrow to pay.
They have third access.
Sounds good. Or incur additional interest payment. Most people, once they incur interest, they try to switch back to transactors. What could have explained that? We actually, let me just go to this slide. There could be multiple reasons, but one reason that we verify in the data is behaving properly, not incurring a lot of interest, not having delinquencies, help one build internal credit score. It helps you to access other functions, other lending services, and that's actually what's driving the proper behavior, right? If you have had that, you're using BNPL, you have less access to other functions. That's where the super app ecosystem idea would come in. So with that, I'm going to conclude here. We are opening the black box of digital wallets for the first time, which includes BNPL transactions. And we can link that to, you know, characteristics and this core idea of payments, which serves as a foundation for many fintech ecosystems. We do find BNPL, internal payment options, dominate other payment options. It essentially serves as a new cash in the digital era. We can only look at some aggregate data in terms of aggregate fiat cash usage and so forth. But it's not too hard to believe that China has transitioned into a cashless society and BNPL is dominating and serving that role of cash. It has a credit expansion effect, and also seems to promote financial inclusion. It does boost consumer spending, yet consumers are very careful with overspending and indebtedness, plausibly due to this super app effect, this ecosystem effect. I'll stop here. Thank you.
All right. So now we move on to the discussion. Deniz, you can start. You have 25 minutes.
All right, perfect. So firstly, thank you so much for having me here. It's a pleasure. It's 9 p.m. I know you're all fresh, so I might be a little bit less fresh than you are. So William, of course, gave a great presentation. This is a super interesting topic. It's super timely. I think the same patterns are being observed everywhere in the U.S., in China, and other countries. So given that this is a 25-minute discussion, I'm not only going to kind of touch some themes that William discussed, but also if you will give a helicopter tour of buy now, pay later. So the first thing is, I think I'm going to focus more on this new way of underwriting, this new type of contract that is buy now, pay later, rather than the payment choice part. That is, if you will, my current research interests. I have a PhD student, Vasuda, who's on the market writing pieces on this topic. But if you will, I'll talk about maybe 2 or 3 key mechanisms that kind of characterize this market, make it different than the credit card market. Maybe that's gonna kind of give some lead to some open questions that some people in the audience might kind of later go ahead and answer. But so in the big picture, right, we've been talking about this fintech revolution. This revolution is happening in kind of 2 ways. One of them is the payment side. Again, most of us don't use any cash anymore. We have credit cards with like chips inside. We don't even have to plug them in. And on the underwriting side, there is also a revolution going on. The type of underwriting is, if you will, switching from individual level to transaction level. Now we can make real-time credit decisions based on what you buy, when you buy, using other digital footprints. There's a tremendous growth, again, maybe enabled by kind of betterments in computation, but like analyzing these issues require data, which is not easily accessible to researchers. So, William talks about this a little bit in the paper. Like things like, these data security laws, kind of make it hard to kind of understand what's going on and kind of open up these boxes. So then, of course, policymakers are interested in understanding what is this financial product? How does it work? Does it benefit? Does it expand access to people who were not previously getting credit? Is it safe? Is it a better contract than previously what we had? So of course the market, think about the credit card product that we had. We had a lot of discontent with the credit card market. We think it's, in finance, we often emphasize the flexibility aspect, but that flexibility, is often not a good thing if you're, let's say, a dynamically inconsistent person, right? If I want to quit smoking, having the flexibility to smoke a cigarette at night, it's actually a bad thing for me. So this credit card market, which people have studied quite a bit and came to the conclusion that it kind of enables debt traps, maybe this buy now, pay later market is going to disrupt that. And it's a better kind of pre-planned installment contract, which is like a commitment contract that's going to kind of lower indebtedness. But then maybe it could also have the effect of just like any other financial product, credit expansion and then increased spending, people going over their heads. We know almost nothing about these things, both because of data and a lack of identification. And then these contracts are different on many dimensions, right? Like we don't understand really what is attracting borrowers to these plans. And then why are they 0% APR? This is quite peculiar, actually. Why are these loans given out for free? Is there some sort of two-sided markets going on? Is there something behavioral about the 0% APR that, if you will, makes the laws of physics kind of bend, that consumers really like it and see it as like a favor? So these are all open questions, if you will, policymakers are very interested in. And then this paper, I read it, I learned quite a bit about all of these issues. So what they do is there's this really unique and innovative data in this paper. And again, opening a lot of black boxes in terms of what's going on inside these e-wallets, and then who's using these BNPLs, what are the effects on it on people. And maybe I'm a little bit biased again, so everything I say about experiments take with a grain of salt. But then there's a randomized BNPL supply shock here, which is very nice. So you can use that to look at causal effects of what happens when somebody is exogenously introduced to BNPL. So then the findings of the paper are positioned around how BNPL interacts with other options, affects payments, spending, and borrowing behavior. Again, I'm going to focus mostly on the buy now, pay later side rather than the payment choice side. But they find that it complements bank credit, it increases spending, it benefits disadvantaged and underserved by banks, and it does not increase indebtedness or distress. So again, I'm not a China expert, but this sounds like a great product for a country that doesn't spend too much, but then without any side effects of this induced spending. So I'm going to talk about a lot of things. My main comment to William would be, again, maybe I'm a little bit biased, but to kind of put the BNPL supply shock experiment, which is the identified part, to a center stage. Maybe that's a separate paper. Maybe it's a reorganization of this paper. And then these outcomes that look like quite ideal, the increase in spending without the increase in indebtedness and distress, try to kind of think about the particular mechanisms. Is it about the underwriting of these contracts? Is it about the pre-planned nature? Is it about the 0% APR? What is it about this market that is leading to this, if you will, optimal set of conclusions? Anyway, let me just give you a quick outline. I'll talk about a few things about buy now, pay later. First thing I'm going to emphasize is this is transactional underwriting, which is different than conventional underwriting. Second, I'll make a comparison between installment versus revolving contracts. Third, I'll talk about the 0% APR. Of course, in finance, we're always interested in tests of financing hierarchies, pecking order, and the like. And then I'm not going to talk about two-sided markets, but I think that's a very interesting open question about these kind of payment mechanisms. Then I'll have some comments about William's execution on identification, estimation, and interpretation. So firstly, what is BNPL? These are short-term credit products, right? It's not like you can take a BNPL loan for more than a year. Maybe like a firm in the US, if you buy a Peloton, they'll lend you for a year. But most of these loans are maybe 2 months, 4 months. Of course, many of these aspects kind of differ from kind of the lender to lender. If there are like 6 characteristics that define buy now, pay later, I would say 4 or 5 of them would hold in any given lender, and maybe one of them might be different. But they're almost always short term. They're almost always fixed payment schedule. Now again, William in the paper talks about some, it could be like maybe you can take a cash advance and then you can have a credit line and then kind of use it as buy now, pay later. So there could be again here and there violations of it, but usually these are installment contracts. They're planned for you. You know what you're going to pay. Now you can always kind of deviate from that, but they are pre-planned. These are always point of sale, meaning you buy something with it. It's not like kind of reshuffling your existing financing structure. It's always associated with spending. So that's very good in the sense that we can be ensured that when people use these loans, they're spending it on it. So if you're interested in analyzing the real effects, then it's obvious these loans are having real effects. Their transaction level underwriting.
Excuse me, Deniz.
Yes, Bernard.
I'm very interested in what you just said. Would you be able to provide a little bit of the arrangement for this buy now, pay out in the 1920s and in Turkey?
Exactly. So let me get that. I'll talk about that in a second. Yes, so that's like my the second bullet point down there. Let me just finish this up. And then these loans are 0% APR. But again, coming to Bernard's point, I don't think buy now, pay later is really new, in the sense that I mean, maybe some of you read like American classic literature, like The Great Gatsby and so on. And I love telling this to my students. Of course, history always repeats. When you think about the 1920s, right, there was a war, First World War, then a pandemic, then credit expansion of the 1920s. This is the Great Gatsby's, and then kind of champagne is flowing, parties, and so on and so forth. And everybody's buying furniture and things like sewing machines on installment credit. And this is a kind of transactional underwriting in which I would not have maybe lent you money for you to buy champagne for your 1920s party, but for a sewing machine, I will. So then when you read to this 1920s credit expansion, actually, I would say this was kind of like the first time there was an explosion in this installment credit that was of the transactional underwriting type. And also, I wrote my job market paper, my thesis in Turkey. So, I mean, I'll talk quite a bit about this paper. But in places like Turkey, Israel, Brazil, these, again, not exactly buy now, pay later, but short-term, 0 APR installment contracts, we've had these things quite a bit a long time ago, maybe like even 20 years ago. And then when you think about this, why do we have it? One reason is it's a Muslim country. People are religious and people are usury averse. People don't want to pay interest. So there is a sense in which if you could somehow bury the interest elsewhere, I think that's the whole two-sided markets. What is this merchant fees coming from? Why do people prefer 0% APR to a discount? But in countries where people are, if you will, religious and usury averse, these types of contracts did emerge. What do I mean by these types of contracts? 0% APR, point of sale underwriting. They were not transactional. In Turkey, they're buried into credit cards. But things like this, we've had for quite a bit. Now, this all could also be for some budgeting reason, meaning like in Turkey, for example, we don't have the word for intertemporal. It's like We know diversification very well. Don't put your eggs in one basket, but things like now versus later, inflation, kind of compounding, we don't really understand them. So maybe it's convenient to say, I'll just split it in 4 and pay 200 per month. But in any case, I don't think BNPL is kind of new in that sense that we had it in the US, but we also had it in countries like Turkey. So very quickly, why do people use this? There was this survey done by a US company. So firstly, this peaked, buy now, pay later peaked in, if you will, 2021. Maybe this was the pandemic peak where we were buying bicycles and home refrigerators and so on and so forth. And then now it has kind of come down a little bit. So again, this is one, is it because of the durable composition or is it because of online purchases? So most people think this will replace credit cards. I think that's a very important point in the sense that I think it would be good if this broken credit card system was replaced by something of this sort. 37% use this to avoid interest. I think this is very important, that this is creating an opportunity for borrowing low and saving high. Like, why is not everybody borrowing on these type of buy now, pay later contracts if they're all 0% APR? If I have in my iPhone everything I can buy with 0%, why am I not getting 5% on my kind of savings account? So then most people say they buy things they wouldn't fit within their budget. Now, is this a lumpy purchase? It could be. But then most of these people can access credit elsewhere in the sense that only a little bit, say 13% say they couldn't get approved elsewhere and because they were maxed out. Now, my own perspective of how credit expansions affect borrower behavior is always precautionary, meaning I think there's very few people who have a credit card and they're constrained. But anyway, so again, how is BNPL different? First, this is transactional underwriting. In typical underwriting, you have a FICO score for you. Bernard has a FICO score. William has a FICO score. You want to take that FICO score to a Rolex dealer and buy a watch at midnight, at 10 p.m. on a Tuesday night. It's not like your credit approval decision is going to be different than if you go and buy a washing machine that you can easily afford. There's one limit, and it's determined by your history, your metrics. Now, most of BNPL, again, maybe not everybody does this, but in the US, most of BNPL is transactional underwriting. Each transaction is individually analyzed. Now, this could be that the left-hand side variable is different, meaning you can use FICO variables to predict defaults in the next month. You could change the right-hand side variables to include what you buy, when you buy, other footprints. Or you could change the conditional expectation operator using machine learning, so on and so forth. Now, I'm going to do a little marketing of my student here. I have a student, Vasuda, who was actually extremely entrepreneurial. I mean, we've been talking about some of these ideas in my field experiments class at WashU Olin. So she has this unique data set from a US-based BNPL firm. She focuses on transactional level underwriting. So there's very little overlap what William is doing. She asks, does transaction level underwriting improve classification accuracy? What is the source of the information in the transaction? How does supply change for whom, and what are the effects on welfare? There's something very interesting that she finds, which is there's been, if you will, two types of literature that kind of argue transactional underwriting, meaning giving you a loan for a sewing machine, kind of improves upon things. Sorry, not for a sewing machine, but like for the transaction. So Annette Wissing-Jorgensen has a paper which says it's what you buy. Meaning, if you're going to buy a washing machine, I infer different things about your personality and your outcomes compared to if you were going to buy a watch. Now, other people say it's not about what you buy. This is a paper by Manjuburi and Berg et al., but it's other digital footprints. Meaning, you use buy now, pay later online. I don't care about your merchant type or what you buy, but I care about if you have your name in your email and so on and so forth. So Vasuda can, in her paper, basically do an analysis in which she can first say, let me underwrite on the basis of the product. Well, then let me move to FICO. And then she can add progressively the internal score, which is the additional information that this company has that is beyond the product and the FICO. So think of the FICO, the product underwriting is like the 1920s. You come to my shop, you want a sewing machine. Going to FICO, I have to kind of decipher some of these, block them out. But going to FICO from product does improve the area under the curve, the classic classification performance measure, by about 13-14%. But once you have the FICO, adding the product doesn't matter. internal by itself is similar to FICO, but then you get the second kick by using internal score on top of FICO. So it's as if the product is not what's driving the results here. It's not the product that's making transactional underwriting, if you will, improve in performance. It's internal score, and that is if it is used in conjunction with FICO, it gives the best improvement. Now, I think this is one of the reasons why William probably observed this increased spending without the default increases, because if it's transactional underwriting that I'm approving some specific loans for specific purposes, then from a category of things that people could buy, I'm not financing your alcohol habit, but I am going to finance your durables purchase. Okay. The second thing is these contracts are pre-planned contracts. They're installment contracts. In this sense, this is different than a credit card. So a credit card, I was thinking about a name to give this. Credit card is like a buy now and you think you will pay later kind of contract. What does this mean? So when people buy on credit cards, they buy today and they think at the end of the month they're going to pay the debt. But most people, come the end of the month, they revise their choices. They are dynamically inconsistent and they're naive about this. Now, a big confusion people always go through is this is not impatience. This is maybe similar to hyperbolic discounting, but dynamic inconsistency is there being 2 points in time and 2 information sets where you make a plan at first, and in the latter information set, you end up revising that choice. So installment contracts of this type where you pay in 4 installments, now these kind of preclude, not strictly, but if you will, it's a soft commitment. So in some sense, people forego repayment flexibility, but I think installments are a better and safer contract. So I have a feeling that maybe we should not be overly concerned about buy now, pay later penetrating and the credit expansion through BNPL, if you will, hurting. I think compared to what we have, the credit cards, this is just a much better product because of this commitment nature, the pre-planned nature. But I think the literature is looking for an evidence of this sort. So imagine you had an experiment where people were randomly assigned buy now, pay later. And now you look at the repayment they have on the next loan. How much of their face value they repay as a function of time. So if you could compare credit card repayment with buy now, pay later repayment and show for the next loan, it is indeed both from the lender's perspective leading to higher recovery and from the borrower's perspective higher repayment, then I think you have fixed this broken credit card market in which these debt traps are perpetuating indebtedness because of this dynamically inconsistent behavior. Okay. So the third thing is, what is attracting these borrowers to buy now, pay later? Obviously 0% APR. This is like an elephant in the room. So this paper is, if you will, studying debt choices from a menu of options, and some of these are cheap, some of these are expensive. Now corporate finance is how corporations finance themselves. This is the second pillar of finance. So then people should be borrowing at 0% BNPL, and they should not be using expensive debt. Like nobody that has access to BNPL, unless they have to, they should not ever touch a credit card. They should try to finance as much as they can with BNPL. And if they don't have the opportunity in the very long run, they should only use BNPL. In the long run, we should all be levered up using BNPL at 0% APR and not use debt for anything else. Now, this is actually something that I find in a paper with my co-author Olivia Kim from HBS. This is the SME experiment. Let me just show you very quickly. So this is an experiment in which there is a treatment and a control group, and the treatment group gets a capacity increase. This is an increase in the capacity at which they can borrow. We followed them for 3 years, and then you see the debt difference on the right. Now we decompose this debt difference into term and revolving. Again, this is not buy now, pay later, but there is a sense in which term loans are cheaper. And the long run response is entirely accounted by term loans. So in the short run, there is a violation of the financing hierarchy. But in the long run, people seem to converge into optimal leveraging targets that minimize the cost of financing. So kind of looking at something like this in the context of BNPL with the experiment that William has, I think would be super interesting. to document that the long run effects of introduction to BNPL is indeed people lever up completely using BNPL. Okay. One other side note, something super interesting, I think, is there is something special about 0% APR loans. So think about the following thought experiment. Suppose you go into a shop and then you have a credit card in the background that you can use that has a 12% APR interest rate. Now, you can either buy the loan for $100 and get a 0% APR loan. That would be a $25 payment. Or you could get a 2.5% discount and revolve it at your 12% APR, and that would be a $25 payment. Now, these are exactly the two streams of payments that are identical, and borrowers should not be in any way, they should be indifferent between these two options. I have a feeling that people prefer a 0% APR loan to a discount. Now, why is this? I mean, firstly, is this true? I don't know. Actually, I found a paper, which is an R&R at AER, because auto loan dealers, they do this, right? They can choose the price of the car, and they can also provide in-house financing. That paper actually finds the opposite, meaning auto dealers, they would like to give a discount rather than a 0% APR or a cheap APR. But kind of an experiment like this that shows the specialness, because this would be a violation of some basic tenet like the weak axiom even of revealed preference. I think this would be very interesting, and something like this is going on. Okay. So I have a few minutes left. Let me just conclude with some comments with William's paper. I mean, again, I think the paper has so much going on. It's a matter of how to reorganize all this matter. My main comment would be to maybe just put the experiment more to the forefront, that given that it's identified. And I think it looks like a great experiment. The standard errors, etc., they look fantastic. I think there could be kind of much more done by kind of reorganizing the paper. One comment is, so it's about the nature of the variation in the experiment. When we run an experiment, we randomize. And we have the choice of using that random variable to decide who gets credit, or how much credit they get, or when do they get credit. Now, for example, in the United States, there is a quasi-experiment that's very often studied. It's about the stimulus payments being dispersed. So not people don't get the stimulus payment every time the same time. It depends on the last two of your social security numbers. Some people get it early, some people get it late. Now, the magnitude is endogenous, but it's just the timing that's exogenous. And you create an instrument, you construct a specification based on that instrument. So in this experiment that William mentioned, the treatment group is offered BNPL and notified immediately. And the control group is offered BNPL 2 months later. So in this sense, what's randomized here is the timing, and I think it would be much sharper if William's paper kind of made use of it.
Deniz, I have to remind you, you have 30 seconds to finish.
I have 30 seconds left. Okay, great. I have a few other comments on the paper, but I will communicate them to Will later on. I think it's a great paper. I've learned so much reading about it. I would just give this randomized BNPL shock the center stage. I would link this outcomes, increased spending without the increased indebtedness. Try to link it to these mechanisms. Is it about the underwriting, the contractual features, the 0% APR? What is it that's driving these results? And some interesting things going on here, right? Like, for example, what is the specifics of this setting that make users carefully moderate their borrowing and spending decisions? William talked about this disciplining feature of this kind of mega app. Maybe if we could learn about that, that could be useful to design kind of features in the United States. And then this whole thing about two-sided markets. What is this merchant fees? Why don't people give discounts, etc.? And I feel like those are great future research topics. Perfect. Thank you.
All right. Will, you want to spend 30 seconds respond? And then I would just open the floor for questions.
Sure. Yeah. Thank you so much, Deniz. And I want to quickly clarify that the draft that we sent to Deniz was an earlier draft, and we actually followed what you suggested in several ways. We now do look into the mechanism a bit more, how the ecosystem actually displaying the behavior And I think it's a great suggestion to link this to the underwriting, the contract. The rates, the interest rate, once people miss the deadline, is actually the same. It's about, I think, annualized 12 to 18%. So it's not so much lower than the typical credit card. But the limits are different. We have a few cross sections on that. We can definitely look more into that. I think that's a great suggestion. And what is so new about BNPL? I love to learn more about, BNPL in Turkey and many other countries. It's true that stores used to offer these install payments earlier. I think what is new here that we might be able to emphasize is the digitization aspect. It's digital, therefore it's scalable. It's massive scale. And it's also kind of innovative. In addition to the kind of installment payment setting, some are designed as virtual credit card. In a way, it goes in the wrong direction, as you suggested, right? Credit card has problems. But that's where the ecosystem discipline is interesting. And that's where China has been different. But I think that's a trend that many other BNPL and digital wallets are converging to around the globe. And that's something we'll follow your suggestion to explore more, including the dynamic empirical specification, which we're already doing that with the ecosystem data, like rental access, tree planting access within the ecosystem. Cause for that, we extended data to 2021, which thought was impossible. Luckily, we got that data, so we can definitely expand on that.
Okay.
Thanks.
Okay. I'm going to cut you off. Yes. Any questions from the audience?
Maybe I will ask not fintech, not buy now pay later, but just that think about the situation where basically you find someone who do not accumulate debt higher, right? That was and also somehow spending go up permanently. How can that be? In the sense that suppose these guys' income doesn't change, and you give them the credit. I thought that the whole point was basically allow people to consume early. And if that's the case, it's basically shifting upward. And I just do not see how can you without touching the leverage, right? Without touching how much you borrow permanently, but still making the people to consume more permanently.
Yeah. That's a great question. So one thing we should clarify is, the indebtedness doesn't go up. People could still be borrowing a lot, but they just pay it off more quickly. They are transactors rather than,
But if you don't accumulate more and more, you just basically pay off.
Yeah. You're saying accounting wise.
Next period, you need to pay more, right? So you have to cut the consumption next period. So,
That's right. I understand what you are, saying, but I want to clarify that first. In terms of why this is happening or how do we rationalize this, I think there are two things happening. Number one is maybe people are managing their indebtedness better. That leads to increase in efficiency, how they, manage their finance, even though the overall borrowing and spending doesn't improve, but overall surplus of profit.
Let's say precautionary level of cash level permanently go down. That could explain that.
Yeah, that's one possibility. I think the other reason is, within the ecosystem, there's some cross sale capacity or cross access, that people could be benefiting from. For example, their internal credit, is going up, credit score that gives them more access to, other types of consumptions that might be cheaper or, for some group of people that could help, as well. But you're right. It has to be something.
Yeah. I just, for someone who's coming from a macro perspective, you have to answer that question.
This was a comment, actually, I had a slide on it, but I agree in the sense that the budget constraint says consumption has to be less than income plus the change in that. So there has to be an expansion on that side. This is an extremely tricky thing to measure, but you guys are actually very lucky because you're arguing it's a cashless society. I mean, whenever somebody presents a paper that says, I'm looking at a policy and savings go up. Now, what do you know about savings under the pillow, right? Or like, let's say there's a policy change and couples bargaining at stance change. Like there are just so many ways in which balance shifting could be going on. Yeah. But if it is the case that it's a cashless society and you can track every dollar, actually your setting would make it kind of ideal for kind of measuring these effects. But just focus.
Right, you're right. In a way, it's a little bit cleaner even than your setting. But it kind of corroborates what you document right in your paper that the buffer stock hypothesis, more liquidity, less precautionary saving, higher consumption propensity. I think that argument chain would apply quite well here. And you're right. We can even argue a bit more aggressively with the data. That's something we should.
Okay. All right. I'm gonna ask my question. And then Bertie, if you have a question, please do later. I have been working on, financial inclusiveness. So I have the following questions. So if all those people have, they used to be excluded in the traditional financial system, now they have this access. What do they use that to do? Buy consumptions. I mean, well, do you get to see what do they buy? What do they use the access for? That's the first question. And second question is, do they really pay back? What's the default or long-term, impact? And number three, do they, I just want to know, do they, you mentioned that they do increase consumption, but then they're cautious. But over the time, do they become more overspending? I mean, it's one shot, right? What's your expectation of the long-term effect? I'm done. 3 questions.
Yeah. All great questions that, I think we've thought through some of them. For example, do they pay back? Is their default rate? That's something we don't observe directly ourselves, but we did ask the data provider to provide the aggregate information. And we were told, within our sample, the default rate is less than 1 point something. And overall it's definitely less than 2%. So default is definitely very low, but are there dynamic patterns that we can tease out? Now we extended to 2021. So we can definitely describe the pattern for the treated and control group. I think it's complicated by, other changes and trends during this period, over these 4 or 5 years, including the pandemic. We have to think a bit harder how to do that. Now, what do they actually buy? I do think we can observe the spending category. So that's something we can look into and report finer.
Whether they buy luxuries or food, medication,
or Bitcoin. Maybe that was spending. Definitely, many people bought Bitcoin in other countries when they get, helicopter job.
And those would have very important policy implications, I believe. And this is a pattern used in an emerging market like China. I'm thinking about, whether when I go to conferences, people from other developing market would ask, you guys have this, does that work? Can we borrow this pattern? Right. So that would be very relevant.
Anyways. Yang and Wenlong, correct me if I'm mistaken. I do think we can observe the categories. By the way, none of these are directly observed. Data stays with the data provider, but we can send the queries.
They'll be very happy to promote their financial inclusiveness.
Right.
Yeah, they'll be happy to show. Okay. Anyways. Bernie, you have a question? Yeah.
Yeah, I have a comment and a question. First, back to Zhibo's question. Because Sumi, Wenlan, and us, we did something, about the QR code in Singapore, and then we talk about the increase in consumption. So we had the same question like Zhibo. So I want to see if I understand this properly. our argument is that now you carry less money in your pocket. That means that your precautionary saving has gone down. But this is a one shot. It's not forever, isn't it? Then the second thing is that there will be a lower borrowing cost for some very small group, very lower income customers, right? So maybe this interest rate differential effect, or the change in interest rate effect, that we'll talk about apply exactly in his case, because the smaller spending, the poorer one, the less served are increasing the consumption. Is my thinking correct?
I would agree with that, and that's consistent with the buffer stock hypothesis as well. It's not only the ones that are strictly whose constraints are strictly binding that would react to this. Those away from the binding constraint from the constraint would also react, but to a lesser extent. I think that would be consistent. Regarding this is one shot change the access to the credit.
So you make $1 billion, you make $1,000 a month. You always keep $100 in your pocket. You carry this 100 forever. So it means that every month you spend 1,000. But in the first month you spend 900, right?
Yeah.
But after that's done, there's no more change.
Yeah. So I think that's again tied to, that's again tied to, life cycle, permanent income hypothesis versus rule of thumb. Do people, use that, make that adjustment right away, or that happens more gradually?
I do think that's about that. It's about accounting. It's about accounting identity. It's not about.
Sorry, what do you mean by about accounting
identity?
Would you mind
he was showing.
I see.
He was showing that the debt level doesn't increase, right? And Deniz also said that it's basically consumption has to be equal to the income plus the change of debt. That's just accounting identity.
Exactly. Yeah. Right.
But
it is possible precautionary part to go down.
Yeah. I thought.
But it's a one shot down, right?
Yeah. I thought Bernie was asking, that change. Why doesn't that happen over time, or why does it happen over time versus just immediately?
There will be an immediate thing, but imagine that in the past, somehow you need to always keep $100 under your mattress. And now somehow this technology, which is not that much about it, buy now, pay later, but you need to think about it, is that suppose this thing changed so that you do not need to save $100 under your mattress.
Well, then, actually, can I add one more detail? I think it's related
maybe that's
to this.
Even so. Bernie, I have to think through. This is why we need to discuss on this. I think you're right now.
Yeah.
So we do think it.
There's a bit,
I'll see you in Hong Kong.
There's a bit more to that.
May I ask another question? Yeah. Sorry.
Yeah.
Will, your turn. Sorry.
Oh. I just want to add one more remark.
I really want to ask one more question.
Yeah. I'll be quick. 30 seconds. Let me add one more piece of information that I didn't get to mention. E-wallet users, they do have a saving account with the e-wallet as well. So basically, this is free liquidity, free credit they can use. And on the saving side, they get a decent return. So it's kind of... I shouldn't call it arbitrage, but that's attractive as well. And anyway, yes, Bernie.
Yeah. I want to ask Deniz a question. I mean, I am very grateful for your excellent discussion, and you push us into a direction that I heard this paper 3 times. This is the first one I heard that will push us into this direction. You point out, and I'm very grateful. I want to ask 2 questions. As I understand it, you're saying that people may build their credit step by step. Am I correct on this one? Then my second, and if that is the case, then I'll ask the question, what stopped me from fooling around, build my credit step by step, and at the end, I take a big car and drive away? Then my second question is that you have this 2 comparison, this experiment. Would you mind to elaborate on what is the bias on that one?
So, in the first point, when you say credit building, if you're talking about improving your credit score slowly, I didn't make any comments about that. But of course, I guess if there is transactional underwriting going on and if they take into account repeat purchases, the first purchase should not be a Rolex watch at 10 p.m. The first thing should be a washing machine. So then those dynamics have to be important. I didn't have much to say about that. I guess my credit building, debt building argument was about debt traps, meaning people get into some debt or they make some payments. They think they're not going to revolve, but then they revise their choices. They're dynamically inconsistent. They make a plan and then they kind of end up revising that plan. And if the contracts are flexible, then it leads them, it kind of gives them the opportunity, right? Again, flexibility is good, but if I am trying to lose weight, I do not want the flexibility to have candy at home. So that was my point. Your second question, you were maybe you're asking about these figures.
Yeah.
So this we interpret as a test of, if you will, dynamic financing hierarchy, meaning we give debt capacity to a subgroup of small businesses, and now they can choose from a menu of options. This kind of mimics Williams' experiment, because in his experiment, he also kind of shocks one kind of financing, and he can look at the dynamics of people's choices among a menu of options. And we find that in the long run, all of the response. So in the previous slide on the right, this is the total debt response. So this aggregates, sums up the expensive and the cheap types of debt. Now we separate them. Now this slide separates them. On the left, you have term loans. On the right, you have revolving loans. And the long run response is 100% after 3 years. It's literally less than 1%, the total response due to expensive revolving debt. So if I were to do this as a microcosm of Williams' BNPL environment, this would say if the BNPL loans are 0% APR. Now, some might be, some might not be, but if there is a 0% APR option, as I find the opportunity to finance things with the 0% APR, I should completely lever up using the cheap financing option. So in the small business world in Turkey, we do find something of this sort, that this short-term violations of the financing hierarchy indeed attenuate in the long run. Okay. And then this, I think, is compatible with some long-run optimal leverage targets.
I hate to jump in again, but we're a bit over time. And if you guys have further questions and discussions, we can move on to emails and other, appointments. I'm sorry, Deniz, I'm the one who always cut you off. Feel very
Somebody needs to improve this. Thank you.
Okay. Yeah. Well,
thank you for keeping the time.
Yeah. Thank me for keeping the time, being brave. Thank you all for Will and Deniz to present and discuss this very interesting paper. I also need to do a forecast of next time. Next time, the presenter will be Bo-Hui Zhang from CUHK, and the title is Unraveling the Dividend Puzzle, a Field Experiment in China. And our discussant will be Xiuming Martin from WashU. Again, WashU. Okay, so I look forward to see all of you guys for the next time. I hope to see you all again. Yeah, well, that's the end of today's broadcast, and thank you again.
Thanks a lot.
Thank you. Thank you. Thank you for hosting too.
Yeah, thanks. Bye.
Very stimulating. Thank you.